A major shakeup is coming to student loans, one that will change how loan holders repay their debt. Congress has decided to narrow the menu of repayment options for students taking out new loans, including anyone who consolidates a federal loan after July 1st, 2026. Instead of the 7 plans that exist today, there will only be 2: the standard repayment plan with fixed monthly payments and a brand new income-driven plan called RAP, short for the Repayment Assistance Plan. RAP isn't ready yet, and it won't be available for about a year. In the meantime, the Department of Education is required to eliminate 3 longstanding repayment options: PAYE, ICR, and SAVE by July 1st, 2028 or sooner. When those plans disappear, anyone with student loans dispersed before July 1st, 2026 will still have several choices: the standard plan, RAP, the income-based repayment plan, or the graduated and extended plans. Another major change is the introduction of lifetime borrowing caps. Graduate students will now be limited to $100,000 total, down from the old ceiling of about $138,000. Professional students, such as those in law or medicine, can borrow up to $200,000. Those who finance an education using a Parent Plus loan will face a new cap of $65,000 per child. By contrast, limits for undergraduates remain unchanged. The regulation also redefines how financial assets are counted when qualifying for aid. Small businesses, family farms, and commercial fishing operations will no longer be factored into the financial aid calculation. This shift could provide some relief for families who rely on these types of assets but were previously penalized in the aid process. Let's dig a little deeper into the Repayment Assistance Plan, or RAP. It's a brand new income-driven repayment option, and it works very differently from the income-driven repayment plans you might already know. Under RAP, even loan holders with the lowest income are required to pay at least $10 a month. That's true no matter your family size, and even if your income falls below the federal poverty line. Your monthly payment is based on a percentage of your adjusted gross income, or AGI, with a small deduction, which is $50 per month for each dependent in your household. Please take a look at your screen. You will see the income brackets and how much those payments come out to be under RAP. Starting July 1st, 2026, the RAP plan officially goes into effect. At that point, both new and existing debtors will have the option to enroll. However, there's an important distinction. Anyone who takes out a new federal student loan on or after this date will only be able to choose between RAP and the standard repayment plan. Here's something else that matters. If you borrow after July 1st, 2026 and want to qualify for public service loan forgiveness, you must enroll in RAP. Remember, public service loan forgiveness clears the remaining balance of your federal loans after 10 years of payments while working in a qualified public service job. I will go into more detail about that in just a bit. For loans issued on or after July 1st, 2026, your repayment timeline will depend on how much you borrowed overall. Please take a look at your screen to see the breakdown of repayment timeframes under the new system. Let's talk about how the RAP plan stacks up against plans like SAVE. On the surface, there are some similarities. For example, just like SAVE, the RAP plan will wipe away any unpaid interest that your monthly payment doesn't cover. That means your balance won't balloon out of control just because your payment is too small to cover the interest. But here's where things take a turn. Unlike existing income-driven repayment plans, which can forgive your balance after 10 to 25 years, the RAP plan makes you wait a full 30 years before cancellation kicks in. There's also one unique twist. If your monthly payment doesn't chip away at your principal, the RAP plan will step in and reduce your balance by up to $50 a month. Over time, this can make a difference, especially for debtors with lower incomes who might otherwise feel like they're never making progress. Now, there's another option some debtors may not realize still exists: the income-based repayment plan, or IBR, but it's only available for loans taken out before July 1st, 2026. IBR works a little differently than the new RAP plan. It still offers loan forgiveness, but the timeline depends on when you borrowed. For some, forgiveness comes after 20 years. For others, it takes 25 years. Not everyone can use IBR, though. For example, anyone with a Parent Plus loan cannot unless they consolidate their loans. Anyone with Perkins loans or other small federal loans cannot unless those two are consolidated into a direct loan or FFEL consolidation loan. Here's how it breaks down. If you borrowed before July 1st, 2014, you're in what's known as old IBR. Your payment is 15% of your discretionary income with forgiveness after 25 years of qualifying payments. If you borrowed between July 1st, 2014 and July 1st, 2026, you're in new IBR. Your payment is 10% of your discretionary income with forgiveness after 20 years. And here's an important detail. Once plans like Save, PAYE, or ICR are phased out, anyone who doesn't actively choose a new plan will automatically be reassigned. Direct loans will get moved into WRAP, while FFEL loans and Parent Plus consolidation loans will get shifted into IBR. If your loans were dispersed before July 1st, 2026, you'll still be able to use the IBR, ICR, and pay plans even after that date. But if you take out a new loan on or after July 1st, 2026, those older options will no longer be available to you, even if you were already in one of those plans before. There's also a deadline debtors need to watch closely. If you need to consolidate your loans to qualify for repayment plans like IBR, ICR, or PAYE, your consolidation must be completed by June 30th, 2026. That means the loan has to be dispersed, not just applied for, before the cutoff date. Because of this, it's strongly recommended that you submit a consolidation application at least 3 months before July 1st, 2026 to avoid missing the deadline. Waiting until the last minute can mean losing access to these repayment options entirely. For Parent Plus debtors, things are a little different. If you must consolidate your loans in order to access IBR or ICR, you don't need to be enrolled in ICR before June 30th, 2026 in order to eventually move into IBR. Parent Plus debtors face some of the strictest regulations under these changes. To keep access to income-driven repayment after Save, ICR, and PAYE are phased out by July 1st, 2028, current debtors with Parent Plus loans must take 2 steps. Consolidate their loans before July 1st, 2026, and enroll in an IDR plan no later than July 1st, 2028. Doing this creates a pathway into the income-based repayment, or IBR plan, which will be the only IDR option available to Parent Plus debtors moving forward. Importantly, Parent Plus loans will never qualify for WRAP. Debtors who don't act before the deadlines will be left with just the standard repayment plan, which means fixed payments and no income-based relief. This could make repayment especially challenging for families with limited income. For those considering new Parent Plus loans after July 1st, 2026, the situation is even more restrictive. Any new Parent Plus debt or consolidations done after that date will be locked into the standard plan only. And starting in 2027, those loans will lose access to financial hardship or unemployment deferments and will face strict limits on forbearance. With forbearance, you can get up to 9 months within a 2-year period. Now let's circle back around to Public Service Loan Forgiveness, or PSLF. Right now, if you're on the 10-year standard plan, your payments count toward forgiveness. But starting July 1st, 2026, the regulations get tighter. If you borrow more than $25,000, the only way your payments will count toward PSLF is if you're enrolled in the new WRAP plan. And that's not the only change coming. Beginning July 1st, 2027, things get tougher for new debtors facing financial hardship. Up until now, you could rely on financial hardship deferment or unemployment deferment to pause your payments if you fell on hard times. But after this date, those options disappear. Instead, you'll only be able to use forbearance, and even that comes with limits. Remember, you'll be capped at just 9 months within any 24-month period. So what does this mean in real life? It means if you hit a rough patch, maybe you lose your job or your hours get cut, you'll have fewer lifelines to keep your loans in good standing. Without $0 payments and with strict limits on forbearance, new debtors will have a much harder time staying afloat and avoiding default. On the other hand, the income-based repayment plan expands the financial hardship rules. In the past, debtors needed to show a partial financial hardship and avoid holding certain loans that didn't qualify. Under the updated regulations, 2 additional groups can now qualify: debtors without a partial financial hardship and Parent Plus debtors who consolidate into a direct consolidation loan and first enroll in the income contingent repayment plan. To meet this requirement, they must make at least 1 full payment under ICR before switching to IBR. There's also another good change. Right now, if you fall into default on your student loans, you only get 1 shot at using loan rehabilitation to fix it. But starting July 1st, 2027, that changes. You'll be able to use rehabilitation twice. So how does it work? Rehabilitation means you'll agree to make 9 consecutive monthly payments that are based on your income. For most loans, these payments can be pretty manageable. But if you've got a Perkins loan, you'll need to make the full standard payment instead. Once you finish those 9 payments, here's what happens. Your loan is officially taken out of default. Collections like wage garnishments or tax refund seizures stop, and your loan is placed back into regular repayment, sometimes with a new loan servicer. But here's the thing. Once you're back in repayment, you've got to stay on top of those monthly payments. If you slip again, you risk falling right back into default. If you're in one of the income-driven repayment plans that's being phased out, Save, Pay, or ICR, your loan servicer will automatically move you into the new WRAP plan by July 1st, 2028. That switch will happen whether you want it or not. The good news is we do have a choice. If you'd rather stick with the income-based repayment plan, make sure you apply at StudentAid.gov/IDR before the July 1st, 2028 deadline. Don't wait until the last minute. Applications take time to process. Once you're in IBR, you can stay there until your loans are paid off, though you'll still have the option to switch over to WRAP or the standard plan later. Which one is better, WRAP or IBR? That depends on your income, your family size, and how much student debt you're carrying. The smartest move is to run the numbers for yourself. I've linked the government's loan simulator in the description. It will give you a clear picture of how these changes could affect your payments. Good luck to you as you navigate all of these new changes.